Welcome. Today's talk is to preview an article I wrote for MarketWatch that was published on June 1st in the Retirementers column. The title is The Best Way to Handle Risk in Your Retirement Portfolio. Here's the essence. Investors think of managing risk as selling equity and raising cash. Frankly, that should be a last resort that is only done in absolutely critical risk situations. Maybe a few times a decade, in fact. I'm talking critical situations. Instead, asset allocation, a mix of stocks and bonds that fits your risk tolerance and your return objectives, that should be your way of managing risk. And then rebalancing the portfolio back to that asset allocation after significant moves up and down in your assets. Here's why. Despite the constant news flow of negative headlines in the press, the reality is that bear markets are relatively rare and most are very brief in duration. This will surprise you. There have only been 3 calendar years since 1960 in which the S&P 500 has recorded a decline of 20% or more in a calendar year. So that's 1974, 2002, 2008. 3 times in 55 years, not too often. Better yet, if you had a balanced portfolio of 60% equity and 40% bonds, which is fairly common, your portfolio would have been back to even and at record highs within 2 years in each of those 3 bear markets. So the worst times since the Depression, and you'd be back at record highs within 2 years. The conclusion is, don't try and catch every downturn. The market is always sending off warning signals, and the media loves it. That sells media time. But it really sustains a decline that will have a substantial impact on your portfolio. So in conclusion, stick with a balanced portfolio allocation of stocks and bonds and rebalance as opportunities arise. That's your advantage. Make volatility your friend and your advantage. There's much more in the article, so please read it either at MarketWatch or at our site, disciplined-investment.com. Thanks for watching, and we'll see you soon. Bye-bye.